Well, time to get more insight onto the bond market. We're joined now by Tertia Jacobs. She's a Treasury Economist at Investec Corporate and Institutional Banking. Good to have you with us, Tertia.
Thank you, Guga.
Maybe let's pick up on a lot of the economic data that we've seen from a global perspective. Just today, the US CPI also being released now. Many people saying that this won't change the stance of the Fed regarding interest rates for the moment because tapering is still their key concern.
Guga, I think what the markets have been focusing on basically is whether inflationary pressures are rising, because when bond purchases by the Fed ends probably in October, the Fed will have to start providing more forward guidance as to its interest rate stance. In other words, when do they expect the first rate hike to materialize? So from that perspective, they're focusing on inflation because the Fed chairperson, like Ms. Yellen, is reasoning there's still a lot of excess capacity in the labor market. Hence, they would like to keep monetary policy, in other words, interest rates, very low. So the only thing that can lead them perhaps to hike rates earlier would be if inflationary pressures accelerate or start to accelerate.
And that hasn't happened just about yet. Maybe if we contrast that also with the CPI data that we've seen out of the Eurozone as well as the UK recently, does that also indicate a similar move, that until those inflationary pressures are on the upside, interest rates will make a move?
I think when one compares it with the Eurozone, there's definitely signs that inflation in America has stabilized, has bottomed out, and it's slowly beginning to creep higher. The Eurozone, on the other hand, faces the risk of deflation. You know, on an annual basis, their consumer prices have increased by only 0.4%. Now, that compares to South Africa, where inflation is rising by more than 6%. So, Eurozone, their central bank is still trying to combat deflationary pressures. Hence, there's the likelihood that interest rates will go up in that region over the next 2 to possibly even 3 years is very low compared to the Fed, where inflationary pressures have started to pick up, and they will likely have to respond earlier. Then, very interesting now with regards to England, their inflation rate has come out, as you pointed out, a bit lower than what the market is expecting. So that then can potentially give their central bank some time or some more time not to increase interest rates, because most central banks are very much focused on combating inflationary pressures, like in South Africa. So that is their mandate. So the moment inflation comes out lower than expected or lower than a target band, it removes pressure from the central bank to become more proactive or respond.
There's also a very interesting meeting taking place called the Jackson Hole conference, I understand, in the US, one where a lot of discussions will be taking place, and we are expecting Janet Yellen to come forward with an announcement with regard to what the decisions were made there. But are we expecting anything to shoot the lights out this time around?
So the conference is more a central bank conference where guys around the world gather together and they discuss a certain theme. So the theme this week is then on labor markets. So Ms. Yellen is going to give, it's a very generic statement, just on the labor markets. So we're not convinced that she will provide new forward guidance to the markets, although she's obviously likely to discuss what they see as the key driving forces of the reason why they see unemployment being so high, and that is where, or staying relatively high, and that is where the big debate is it cyclical or is it structural? So if they continue to believe that it's more cyclical, they would reason, yes, we need to keep interest rates lower for longer. When it is structural, you could potentially see a quicker acceleration in wage pressures. So it's very challenging, and because valuations on bond yields are so low, okay, or expensive for that matter, and the market is pricing in a very slow increase in interest rates in America. They will monitor and examine every word that comes out of her mouth. So there is potential a bit of volatility risk if she is less if what we call dovish,
Mm.
if she's a bit more concerned about wage inflationary pressures. But I think she's probably going to continue to try and balance it, because, you know, they don't really want to see market rates increasing, because the housing market is still very closely, or financing of the housing market is very much dependent on the longer dated bond yields.
Sure. Well, I'm sure she'll have a team of people making sure that she says the right things. But Tertia, unfortunately, we've run out of time. Good to have you with us as always. That was Tertia Jacobs, Treasury Economist at Investec Corporate and Institutional Banking.